And Charles, I can tell you the Federal Reserve keeping rates the same. The Federal Reserve saying they're remaining patient on this. The range of the federal funds rate is 2.25% to 2.5%. The Federal Reserve still watching the global economy and financial developments, as well as muted inflation as possible headwinds here. Now, in the Fed statement, the Fed says they can be patient with that muted inflation. The upgrade, or Federal Reserve upgrades the assessment of the economy, though. The Federal Reserve characterized economic growth as solid, a change from March when it said economic growth had slowed. Now, still, consumer and business spending had slowed in the first quarter. Now, inflation playing a big part of the changes in the Federal Reserve statement. Inflation, again, noting that it has declined. Now, board members acknowledge that excluding food and energy, it's running below 2%. Now, core PCE, we know, is 1.6%. On the balance sheet side, the Federal Reserve says that they will begin the shrinkage of the tapering. So they're going to roll off, instead of $50 billion a month now, they're going to start to roll off $35 billion a month, and that ends the roll-off in October. The Federal Reserve Chairman Jerome Powell says that the balance sheet will be somewhere around $3.5 trillion. On a technical note, the Federal Reserve did lower the rate that it pays for bank reserves. Now, that was done to keep the target federal funds rate within the range of 2.25% and 2.5%. It had been pushing the upper range of that, so they lowered that. This Fed decision, or in the statement, was unanimous. Charles, wait and see. That's still the word of the day. Patient for the Federal Reserve. Back to you.
Edward, thank you very, very much. Appreciate it. And here to help break this down, folks, former Dallas Fed advisor and Quill Intelligence CEO Danielle DiMartino Booth. Stifel's chief economist is Lindsay Piegza. Point Bridge Capital and MAGA Fund founder Hal Lambert joins us, as well as Money Map Press, their chief technical strategist, D.R. Barton. Lindsay, let me start with you. First of all, anything so far from what we've heard jumping out at you from this?
No, the statement was pretty much as expected. We saw rates unchanged. We saw the Fed reiterate their patient stance, so justifying their position along the sideline. They also maintained that relatively optimistic view of the economy. What really is of importance is when we watch that press conference, and we're going to be looking for the chairman's assessment of this seemingly solid growth against the backdrop of this disinflationary environment and what that means for rates going forward. So that really is going to be the highlight, waiting for the chairman's assessment of what the most recent data means for rates going forward.
Hal, of course, the data is somewhat mixed. I mean, we had that great first quarter GDP report, and as Edward Lawrence says is that the Fed acknowledges that by going to solid from slowed and with respect to the economy. But, you know, there's still pockets of weakness. Housing is still extraordinarily weak and worrisome. Today, we were reminded that manufacturing is extraordinarily weak and getting worse. Maybe the U.S. moat, economic moat, won't fend off global weakness. So how does the Fed juxtapose those things?
Well, Charles, as you know, I started saying last summer that the Fed should put a pause button on raising rates, and they shouldn't have raised in December. Inflation is not there. We don't have it. And this GDP number at 3.2, there were a couple of anomalies in there. There was the inventory number was much better or much higher than expected, and then trade was different. So if you look at that, the GDP number was maybe a little higher than what would be expected for this next quarter. So the big question I have, Charles, for Powell, and actually what ought to be asked of the next nominee to the Fed, is what do you think potential long-term GDP growth should be? He's saying it's low 2%. You know, 2.2, 2.3% is potential GDP. That's a problem because we need GDP over 3%. We need 3.5%, 4% GDP, as President Trump has said, because that's going to help our debt number. That's going to help the debt to GDP number that they're talking about. And we can do it without inflation. We're seeing it now without inflation.
Hal, I know where you're going. And you know what? I've got 4 reasons and theories why people are out there saying we should have lower rates or rate cuts, and I think you're alluding to one. I want to get Danielle's initial read on just what we've heard so far and what you were expecting.
I was expecting Goldilocks, and we've got Goldilocks in the House. They upgraded their assessment of the economy, but by the same token, they acknowledge that global trade is not improving. They continue to point that out. They also brought up the fact that inflation, according to their very broken metric, the core PCE, has indeed trended down. We're seeing it at 1.6%, which is obviously below the Fed's 2% target. So what they're trying to say is we've got wiggle room. What we're looking for in the press conference from Jay Powell is whether or not he's going to bring up whether they would do a preemptive, an insurance type of rate cut.
That's why your hashtag is making the rounds today, insurance rate cut. Why, just without getting into the weeds, are you saying this, the way they measure core PCE is overstating or understating inflation?
It understates it to a tremendous amount because they gauge health care, which is, you ask any family in America, that's one of their biggest expenses, but they gauge health care based on Medicare and Medicaid reimbursement rates from the government. Well, guess what? I pay a lot more than that. You pay a lot more than that. But again, that's what skews that number downwards. Well, the rest of us on planet Earth live on what the CPI says at the headline, by the way.
DR, the market's gaining just a little bit of traction. More than likely, will trade somewhat sideways, I guess, until you can hear from Jay Powell himself. Nevertheless, this is a decision that the market's really looking at, particularly as the Dow's on the cusp of making an all-time high.
Yeah, I think you've nailed it there, Charles, that we're up 3 points. I just glanced down. We're up 3 points. S&P 500 points, and that's a little bit muted with them coming out with the solid adverb adjective that everyone's already been talking about. So I was expecting a little bit better pop if they talked positively about this. What we'll see is if the Fed chair, if he's going to put in some dovish language. I know UBS had said they had some leanings that was what was going to be coming out this afternoon. If that happens, and I think we can push this thing a goodly bit higher even this afternoon.
All right, so there's a lot of theories out there as to why the Fed should cut rates. One theory is that there's no inflation. They've got room to do it. Another theory is that there's a liquidity issue. Maybe that's why they took the action they did today with the bank reserves. There's another theory, and I think Hal was leaning toward it. President Trump's tweet was pretty bold about this. Hey, why not make the economy stronger? What's wrong with the Fed? Why won't they help this economy out? And the third one is they made a huge mistake in December. It's a great opportunity for them to make that up. And, of course, there's always a fifth one, that the economy is getting weak. Lindsay, any of these legitimate issues in your mind for the Fed to begin to look at lowering rates?
I think number 1 and number 5 are very legitimate. I do think that the Fed has, as they said in the statement, acknowledged some of the early signs of weakness. So they're not concerned about what growth was in the rearview mirror, but they are concerned about this declining trend among consumption and investment. So the two key components of the economy as we move further to the end of the year. So that's one argument that I think the Fed is going to be making, and I expect to hear that from the chairman. The second is the fact that we don't have the inflation. Inflation is well below the Fed's 2% objective, and in order to further stimulate price growth as well as keep the economy on track, or this recovery on track, there's plenty of room for the Fed to offer that first rate cut in this cycle. So I think there's going to be a lot of arguments made. Although no Fed official at this point is talking about rate cuts, I do think they're going to open that door further to the conversation of the first rate cut at this upcoming press conference.
Yeah, so I'll just jump in here, and Rich Clarida himself, actually, who's the vice chairman of the Federal Reserve Board, has become he's become a very big personality. You can see his influence growing stronger, and he has indeed spoken of past times in Fed history that they've come out and put out an insurance rate cut. So the discussion's definitely occurring around the table right now, and we have to remember that back in 2001, when there was a shock for the markets, obviously, that Greenspan came out with a 50 basis point rate hike, and clearly the president and his advisors are studying Fed history, because they're saying that we don't even if we do have an insurance rate cut, it doesn't have to be a quarter percentage point, it can be a half percentage point.
All right, now to that point, folks, we had this ISM number out today, and it was extraordinarily weak. It missed Wall Street's consensus. We're still in expansion, but we're dropping precipitously. The headline number was the weakest since October 2016. New orders the weakest since December of last year. Production the lowest since 2016. Employment the lowest since February. And two categories dipped into contraction: export orders and imports. I mean, so how? How do we reconcile something like this on one hand, but on the other hand, where we're saying, well, this is an extraordinarily strong economy?
Well, globally, we're not strong. And you saw that's why China's done stimulus. Japan's trying to do stimulus. So that's, I think, a big part of this. And the Fed's come out and said, look, globally we've slowed way down. The U.S. is going to be a part of that. I mean, the U.S. does a lot of exports. If globally we're weak, the U.S. should slow down as well. But again, I think this goes back to what I said earlier. I think potential GDP should be viewed as much higher than it is. I think productivity is way understated in this economy. And I think that's a big thing they're missing. And therefore, we ought to be looking at 3.5 to 4% GDP. Why shouldn't we be? We had many, many years in the 90s where we had over 4% GDP growth. We had, in fact, we've averaged 3.2% GDP growth since the 50s, and we've averaged over 4% in the 50s and 60s. So there's no reason we couldn't do that with the technology that we have today and the productivity increases that we're having going on. So I think the Fed should easily be able to cut rates. Certainly 25, maybe 50 basis points, as we're seeing some of the slowdown that's happening out there. Yeah, jobs look great, and that's great, but we need increases in wages. That hasn't caused inflation. We're starting to see that,
right.
But inflation's not there.
Earlier this year, when Powell suggested, or he reminded folks, at least he told them that wage inflation is different than price inflation. That's when this market took off, because I thought the Fed was signaling to the world, hey, we're not going to go by the old playbook that as soon as wages increase by more than 3% on Main Street, we're going to take away the punch bowl. And I think that's fantastic for Main Street. But what about the notion, though, that we can even do more? You know, DR, President Trump yesterday, his tweet said China's adding great stimulus to its economy while at the same time keeping interest rates low. Our Federal Reserve has consistently lifted interest rates even though inflation is very low, and instituted a very big dose of quantitative tightening, which is still going to be $35 billion through most of the rest of the year. We have the potential to go lower. I mean, maybe not a whole percentage point, but what would that do for the market if that were the circumstances, DR?
Well, any more accommodative stance is going to do a lot for the market, and we'll see when Fed Chair Powell comes and talks, if he gives us some of that, if he gives some signaling that that's going to be happening. We won't even have to have hard things. We won't even have to have him give numbers and dots, and he just has to have some more dovish language, and we would see it reflected here, because that's what the market is really knows, that with that extra accommodation, that's really about all we need. With the rest of the world, we've already talked about being a little bit to a lot weak.
Mm-hmm. Right.
The U.S. stock market is really the risk asset place to play, and that's going to be a big boost. Anything we hear from
that would be significantly more than your insurance rate cut.
Oh, absolutely, it would be. But look, Charles, I wish we had Gary on set with us right now, because he would be howling, he'd be screaming, he'd be saying, look, debt has grown at 4 times the rate of GDP since the 1960s. Is this the American way? Is this how we're supposed to grow our way to prosperity? Are we supposed to follow in China's footsteps and put out record levels of stimulus in the first 3 months of the year? Look, they took their foot off the accelerator in just this month of April, and we've seen their stock market tick back down 7%, and it had led everybody.
Maybe these central banks have put themselves in a position where everyone has crossed the Rubicon.
Right, exactly.
Maybe you, Gary, and everyone else who hates what the Fed is doing, it's just an antiquated way of thinking, because they can't go back without crushing this thing.
It's a race to the bottom, Charles, and that's absolutely how you have to look at it.
If rates stay low, though, then can theoretically the Fed be more accommodative? Can our debt levels go higher?
Yes.
Could we sustain that? If Powell's right, if we had a 4% GDP, in part because the Fed was cooperating, would that be enough to mitigate the dangers of higher debt?
It could be, it might be, but the things that we're seeing in the 2 sectors that lead the economy, we've seen one headline after another today with weak car sales, retail car sales. That's what you and me buy in the dealer lot. They were down 1% in 2018. They've been down every single month this year, and we've seen that a 10 basis point increase in mortgage rates has been enough to slam the housing market into reverse. Right. These are not the 2 sectors that you want to see weakening, despite the fact that interest rates are so low.
Although we may have been at peak auto for 3 years, but housing, I'm with you 100%.